Clement, you've taken the workshop, haven't you? Haven't you taken the Double Eagle workshop? Yeah, excellent. How's your trading going? Fourth quarter last year was rough, right? But the first quarter, yeah, the first quarter this year has been awesome. The second quarter is getting off to a great start too. So, okay, so that's what we're here to talk about. Yeah, Clement, if you ever need any assistance in making trading decisions, you can always reach out to me. We are here to support our Double Eagle traders for sure. Welcome, everyone. Disclaimer says that we are at OptionSlam.com. We are not licensed financial advisors, so we do not make investment recommendations nor give advice. Etc., etc. Please read and understand the CFTC rule before you risk real money in the markets. I am Marko. This is my email address, OptionSlam.com@gmail.com. Love to hear from you. Questions, comments, suggestions. So I've got a lot to cover today, so please, jot down my email address in case I can't get to your questions in the session today. I'll get back to you by email. So this is a chart. People have asked me for years, how much money can I expect to make with this strategy? So I'm just going to start off right from the beginning here, right at the first slide here. This chart represents a chart of about 1,600, I think 1,608 or 1,609 trades that were put on with the Double Eagle. This is on about 100 stocks. We follow about 100 stocks that do really well with this strategy. Okay, the trade, these are the days to front expiration. 0 day is front expiration day. And this is all the trades in our database that are conventional Double Eagle. And this is the winners and the losers. I'll show you the breakdown and statistics later on in this webinar today. But as you can see, if you would have just put this trade on, every winner, every loser, held them all, made no adjustments. These are completely unmanaged. So we actually can perform much better than this chart suggests because we manage our trades actively. We adjust our trades as they get into trouble. This represents, I forget how many hundreds, I think it's like a 60. So I know that what question's coming, how much can I expect to make? So I figure I answer that question before we get to the end, because that's always a question that comes up in the end. All right, so you're going to hear me refer to the workshop during today's presentation because today at the end of the presentation you're going to have an opportunity to join in, register for the workshop. It is a paid event. It is a very intense training exercise that lasts about 5 weeks long, okay? Once a week for 5 weeks, basically, is how it goes. So we'll get into that later. So if I refer to the workshop, that's what I'm talking about. That will be at the end of the webinar today. So trading the Double Eagle, we're working with two main distinct edges. We exploit time decay in combination with exploiting implied volatility build. We're selling time and buying volatility simultaneously, okay? And we're doing it centered around a known binary event, which is the earnings release that's coming up in the near future, which causes anticipation and therefore the implied volatility build. A way to sell option premium with a high probability of success is to sell pure extrinsic value. In other words, out of the money contracts. Sell sell out of the money contracts that have low probability of expiring in the money. When you sell them, you collect the premium, which is pure extrinsic premium. Therefore, we're going to sell an out of the money call, sell an out of the money put. We sell, and that by itself, of course, is selling a naked strangle. It's not what that's just part of our strategy, but that is part of our strategy. We're going to sell a naked strangle. We're also going to buy a strangle to define and limit our risk in the trade. We're going to sell options that will not benefit from rising implied volatility due to the anticipated earnings event that's coming up in the near future. But to define our risk, okay, because that's fraught with lots of risk when you're selling a naked strangle, right? So to define our risk, we're going to buy another strangle in a expiration cycle that is after the earnings event. These options, the ones we're buying, are going to benefit from the rising implied volatility due to the upcoming earnings release. So let's take a look. This is the options chain. This is not a stock that has earnings. This is to illustrate what a regular double calendar looks like and the mechanics of it, and a quick peek at the Greeks and the difference between our short contracts in the front that we're selling and our long contracts in the back that we're buying, okay? So here first we're taking a look at, you see down below, we are selling one 1560 call, one 1450 put. Now at the time I created this slide, that was, price was right in the middle. Looks like it was 324.19. So what's that, about a week ago or so? All right, so it's pretty fresh. I'm sure that the price isn't perfectly in the middle anymore, but for illustration purposes, this is great. Okay, so we're selling a call, out of the money call, selling an out of the money put. The stock was at about 1505. You see we're selling way above the money and way below the money, out of the money contracts. Now, we're going to flip back and forth between this slide and the next, just to show you the difference between these Greeks. But what we have here is delta, and I'm highlighting theta and vega, okay? Same thing over here on the put side, delta, theta, and vega. So this contract that we're selling is only got a 25 delta, okay? So it's about, it's got about a, and if you think of delta as a proxy for probability, it only has a 25% probability of expiring in the money. We're selling another call over here that also only has a 25% probability of expiring in the money by the expiration date of these contracts. So you see how this is a very high probability trade, actually, right? Probably a full 68% probability of profit in this trade. So that's part of the trade. Let's go to the next slide. And just see, this is graphically what that naked strangle looks like. You keep the premium as long as price stays in between the strikes. In fact, plus an extra bit of range within which to capture profit because you collected all that money. So you can actually go past the strike by the amount of money that you collected and still be above the zero line, okay? Problem with this risk graph is it subjects the trader to unlimited losses. Limited defined profit potential, unlimited losses. The next step in creating the double calendar is to buy the volatility in the double eagle. That's what we want. We want to buy implied volatility with the idea, the idea that implied volatility is going to increase as we hold on to the trade, and therefore offset the theta decay that comes along with buying options. Okay, those fronts that we sold, they aren't going to get the IV build. So they're just going to have pure theta decay. And the backs that we buy, they're going to also decay due to theta, but at a slower rate. Not only at a slower rate, that's to our benefit, but with the added benefit of implied volatility build. The rise is associated and specific to the upcoming event. The IV rise can be from a modest few points in certain stocks. Like I mentioned, we follow about 100 stocks. And some of the stocks that we have just staggering, sometimes even doubling of the implied volatility from trade date to front expiration date. Okay, so some terms that I'm going to use: trade date, that's the day we put the trade on. Front expiration date, or you'll see it abbreviated with an FE, front expiration date, that's the date that our short contracts, the ones in the front, the shorter dated options, are the ones that we're selling. So we're short the shorter dated options. Those are the front expiration. And the back expiration, we're long the contracts in the back expiration. Those are the contracts that expire after the earnings event. So now this is a risk. This is the back. See, the May 17th. The previous option chain that I showed you was the April 18th. Okay, so monthly options we're looking at here. So here, if you'll remember, those April options had 25 delta. So we're selling 25 delta. We're buying 33 delta. So we've got a little more probability of profit here. We've got a situation now where as price moves towards one of our strikes, whether it's the put strike or the call strike, as price moves towards one of our strikes, our longs are making more money than our puts are losing money for our position. Right? If we sell this 1560 call right here in the front dated, in the front expiration, April 18th, they're losing, as price approaches that call, we're losing 25 cents of premium to the buyer of that option. However, we protected ourselves against that by buying the 1560 call, and that's making money at a higher rate than our shorts are losing money for us. That's how delta is working for us, and we have a built-in edge in delta. Also, let's take a look at theta. We're losing 36 cents a day to theta decay in this particular call strike in the longs. This is the longs, the Mays. But if we take a look back to, okay, so that was a 36 theta, and let's do Vega at the same time, so I don't have to flip back and forth so many times. 36 theta and $2.09 in Vega. Now, I just flipped back to the Aprils. Look at 49 cents in theta. So we're losing 36 cents in our longs, but we're gaining 49 cents in our shorts. As price moves along in time, as stock moves along in time, day by day by day, we're gaining more money in the short contracts than we're losing in the longs. So now we got deltas working in our favor. We got theta working in our favor. In the workshop, we'll get into the discussion of gamma as well, because that comes into play in this trade in a very strong way, especially towards the end. And then we had a 209 in Vega in our longs. Remember the last slide? $2.09 in Vega. What is Vega? That's how much premium, that's how much our options are going to increase in value with every point rise in implied volatility. Not only do we have a larger Vega in our back contracts, on our long back contracts, but this Vega isn't really going to hurt us at all, because this Vega is going to deteriorate to zero by front expiration day. We want to be out of this trade we are not going to hold this trade through earnings. We're putting this trade on weeks ahead of the earnings event. And then we're going to close it front expiration day. Earnings aren't until the following week. Okay? And our long contracts are sometime after that. It varies on what variety of the double eagle we have initiated. Okay, so I won't spend any more time on this, but I just want to. This is one of the reasons why this trade works. Delta's working for us as price approaches. Theta's working for us as time goes on, and Vega is working for us as implied volatility builds as we approach the earnings event. Okay, so the buying those longs, now we have this particular risk graph. It's the opposite of selling, right? It looks exactly the opposite of those short fronts. It's the exact opposite. This has defined risk. Okay, we can't lose any more than what we paid for these options, and unlimited potential for profit. Now, you put this risk graph together with the other risk graph, and you do all four of those options at the same time, the four legs of the trade, and you get a risk graph that looks like this. It looks like, yeah, a circus tent. And the reason I put this photo up here is because we often refer to our trades as certain things that relate to the circus tent profile. We got the tent poles. That's where our strikes are. This is the call strike, and this is the put strike. That is where we have the potential to make the most amount of money, is if price goes to one of those tent poles. And then we have the sag between the tent poles. This is where we start out the trade with price right here in the middle. But by the time we get into the front expiration time, we expect price to be approaching or near one of these tent poles. So in risk profile, on an analyzed chart, with that Russell trade, and we do all the contracts, we are long the Mays and short the Aprils, the calls and the puts at the same strikes. It is a debit trade because the ones we're buying are more expensive than the ones we're selling, right? Because they're further dated options. They are further out in time. So further dated options further out in time are always going to be more expensive than shorter dated options. So it is a debit trade, and our risk is defined to the debit. Our risk is the debit. You can't lose any more money in the trade than the debit of the trade. So you know going in what your maximum risk is. Another beauty of the double eagle. Now this is not a double eagle. This is a regular double calendar on an index which does not have earnings events, okay? Again, this is all to illustrate the difference between a regular double calendar and a double eagle. Because some people have said to me, oh, Marko, you're just a double eagle. That's just a double calendar. It's not just a double calendar. It's very different because well, let me go on, and I think you'll understand. The trade is very delta neutral as we enter it. True with this trade as well as a double eagle. It's very delta neutral. We don't care if the stock goes up. We don't care if the stock goes down. We don't really care if the stock sits around in the middle. We would like it to go up or down to one of our tent poles because that's where the most profit can be made. A regular double calendar has positive theta. It's making money with time decay. Double eagles are a little bit different. They're not always positive theta. Sometimes the theta picture varies in a double eagle. And I'll have to explain why in the workshop. It's a kind of a lengthy discussion. And the Vega is definitely positive. We have a net Vega of 159. We actually have higher Vega than that because we expect the fronts to expire worthless, and we expect their implied volatility to go to zero by front expiration day. So this is the net Vega of the position. Our double eagles, we actually have a much higher Vega than what the analyzed software represents. Okay, so Normal double calendar versus double eagle. Regular calendars and regular double calendars are a common strategy which are typically applied during times of low volatility. When you hear all these teachers and options education gurus out there, they say, oh, we're in low volatility. That's a good time to put on calendars. Oh, we're in high volatility. Don't put on a calendar. Not a good time. As double eagle traders, we put on double eagle trades in high volatility and low volatility. We put them on every week of the year. That's right. We have opportunities to put these trades on every week. Yeah, some weeks are busier than others, but we have our busy season. But even in the slow season, there are trades available for us to put on. So I'm literally opening and closing double eagle trades 52 weeks a year. All right. So regular double calendars, they generally come with a set of rules and prerequisites, which the double eagle traders almost completely ignore. For example, most options educators, when teaching how to trade a calendar, will tell you to always trade when volatility is low. Never enter a calendar at high IV. They'll tell you to sell high IV and to buy low IV. They have other guidelines too. Always, but buy at least twice as much time as you are selling. Always buy at least twice as much time as you are selling. Always collect at least half of the premium when selling the fronts as you are paying for the backs. So these are all the rules that you're going to hear from people teaching how to trade calendar spreads and double calendar spreads. However, as double eagle traders, we pretty much ignore all those rules. In fact, we break almost all of those rules. We are selling low volatility and buying high volatility. Cardinal rule number 1, broken. Pretty much we break all those rules as double eagle traders. So you can see the beauty of a double calendar spread in profile in risk graph, right? It's got a very wide range of potential for possibility of profit, right? Very wide range. Looks like it's almost 1 standard deviation in this case. Very good risk to reward ratio, making at the temp holes, making almost as much money and maybe even more money than the entire debit of the trade. You see how the risk to reward ratio is really about 1-to-1 in this example. I have to tell you, double eagles don't look this pretty. It is completely different than this trade, and let's see, some of those differences are represented graphically again in the next P&L risk graph. So let's move on to what does a double eagle look like in risk graph. Instead, you see here a double eagle profit and loss risk graph looks absolutely terrible. The entire front expiration green line here represents the front expiration contracts. When you get to front expiration day, which is the day we want to be out of the trade, it looks like there is no way to make money with this trade. When you put the trade on, and when I put these trades on, when all double eagle traders put these trades on, we often see risk graphs that look like this. Some of them look a little bit better with the temp poles slightly above the zero line. Some of them look even worse with the temp poles completely way down here, way below the zero line. The main culprit and the main reason why the risk graph looks like this is because of the implied volatility that we're buying. When we enter these trades, we're buying options that have already experienced somewhat of an IV build, naturally have a higher IV in those back long contracts because those contracts are going to be still alive, still in existence, not expired when the earnings comes out. When first initiating these trades, it looks like a suicide mission, right? However, as double eagle traders, we trade these every week of the year. because we know that the Greeks are still working for us. We got delta working for us, we've got theta working for us, and we've got vega working for us. We'll get into those Greeks in a little more detail in the workshop and show you just why the double eagle works and is the most consistently profitable trade that I'm aware of. Pretty much, folks, this is what I trade. I dabble with some other strategies, but well over 80% of my trading is involved in double eagles. Earnings and implied volatility. Let me read my notes here. A very important fact is that we keep track of each of our stocks' implied volatility build. We have a team that works together here at OptionSlam. We've got a team of people that are keeping up a database, and we keep track of a lot of stuff. We keep track of our 100 stocks, when their next earnings release event is going to be. If they haven't announced it or they don't announce it on time, we have a tool, we have a set of tools that we estimate when the next earnings event is going to be. About 2/3 of our stocks don't announce their earnings release date in time. Fall of October, must have been right in the end of September, okay? And this, as of the date of this, the date was estimated. Okay, so the estimated date was October 31st for the earnings to come out. So what I want to point out to you here is October 31st earnings release is estimated. You see the earnings, the options that expire prior to October 31st are holding implied volatility here, 27.5%, 26.75%, 26.75%, 27.5%, 27.5%, all right in there. Bump, 34.33, huge implied volatility build a month before the earnings event is even going to be around. And it's just an estimated date at this point. It's not even confirmed, okay? But the options market is pretty sure that they think they know when the earnings is going to be, because that's what's causing all this implied volatility. So that's the problem with the double eagle, right, is we're selling low IV, we're buying high IV, and that's why the risk graph, that's the main reason why that risk graph looks so terrible. The thing is that we know as double eagle traders, though, we not only know that implied volatility is going to build from 34 and go up, but we know how much, because we've been keeping track of it for years, and we have historical statistics to back up our claims. And again, I repeat, if we're selling this implied volatility, by the time we get to that date, that implied volatility will dissipate to zero. There is no implied volatility left on front expiration day in the fronts, right? They either expire in the money or out of the money. We're selling out of the money contracts. If they expire out of the money, all volatility goes away. All theta decay is eroded out of those option premiums. They expire worthless, and we keep the money that we sold those contracts for. In the meantime, we're still experiencing implied volatility building in the long contracts that we're holding in the backs. Netflix. Okay, so this is actually a trade that I'm in. You can see the expiration risk graph. I've been in this trade for a few weeks now. You can see that the expiration risk graph looks terrible. Okay, but it continues to change. When I first put this trade on, these temp poles were completely below the zero line. They were way down here in negative 200 zone, if I remember right. Okay, but even though the risk graph looks terrible, this trade's actually more profitable. I took the screenshot about a week ago. It's actually higher profit than that today. I think I can show that to you. Let me see. Let's go look at that trade. Yeah, right there. Netflix today is at, the profit on that trade is about $300. You see, $300 in an $869 investment, $300 divided into 869. That's only 34.5%, folks, of profit that I can close that trade for right now. 34.5% of profit against risk. $300 of profit against an $869 debit. Are they all winners? No, they're not all winners. We do have losing trades. I told you that right from the very first screen. They can't all be winners, but the statistics are with us. Research team had a high confidence rating on their estimated date. So I took the chance on an estimated date trade, and those can go wrong. They do go wrong sometimes. But that's what trading is about. You can't make money unless you take risk. We have specific guidelines to follow to enter the double eagle. Primarily, as I've already mentioned, we must sell options that expire prior to the earnings release cycle. We must buy options that expire after the earnings release cycle. We must choose the right strikes. We must enter the trade timely, really important. And we must choose stocks with performance history. Not all stocks work well with this trade. Why not trade confirmed dates only is a question that we get oftentimes. And as I mentioned already, 2/3 of the stocks on our list of 100 do not announce their earnings date soon enough to get the trade on timely. We have back tested, forward tested, tested with real money, tested in every which way but loose, the double eagle strategy for years. And we have cataloged all of our statistics into a master database. And we have found that we need to enter these trades 4 to 5 to 6, sometimes even 7 weeks ahead of an earnings event. And then we want to try to hold the trade as long as possible into that front expiration, because that's when the big profits usually come. Sometimes we can get a large profit. Sometimes, last week, I put a trade on and was able to close it the very next day with a 30% profit. Now, that doesn't happen very often, but it does happen. It's happened to me before, sometimes even better profit than that. Okay? So, but the general rule of thumb is that the larger profits come in that final week, right before the fronts expire. In fact, the last 2 days is when the largest profits generally show up. Okay, so there is potential for faster, and often the reasons why we trade, some of the reasons why we trade estimated earnings dates. First of all, we don't have enough stocks that confirm in enough time. 2/3 don't confirm in enough time. So we need, so that we have enough stocks to trade, we need to do that. Now, not only that, but these estimated day trades have potential for faster and sometimes superior results over trading confirmed date trades. Okay? There is extra risk, but there's also extra opportunity for profit. There's not enough stocks that meet our criteria that also confirm in time. I've said that enough. Confirmed date trades already have IV built into the back expiration cycles. No opportunity for an IV bump benefiting the P&L. I think I have a slide to show you about that. Let me move on. And let me read this from Bakim. He's on our research team. Bakim is one of the first people who took the Double Eagle training course from me quite a few years ago. Okay, quite a few years ago. Bakim is an excellent trader. He says, "Dear Marko, as you know, I took the Double Eagle workshop a few years ago. That was probably the best trading decision I ever made. I have exciting news to share with you. Yesterday, 4/17/18, it was announced that I won the fall 2017 through spring 2018 trading contest at OptionSlam.com. It's a 6-month trading contest against 40 professional traders. Bakim Bekeem says, I came in first place. I did it by trading the double eagle strategy exclusively that you taught to me and the other traders in the workshop. I can't thank you enough for the excellent workshop training experience. Sincerely, Bekeem. And then this is published by the Options Tribe with the results showing Bekeem over that 6-month period came in with a 36% profit against risk, which quite frankly blew away the competition. The next runner up was at 13% is a very, I used to be very happy to make 13%, right, on my trades, average 13% on my trades. But I am spoiled now. We saw this plot earlier. 0 day, again, is front expiration day. This assumes, this is from our database, this assumes all trades put on, initiated, and held to front day, and it shows what your P&L would be if you closed all the trades 5 days before. Looks like about 23%. If you closed all the trades, winners and losers, 10 days before front expiration day, looks like about 15%. If you held till -1 day, the Thursday before the Friday expiration day of the fronts, looks like about 27%. This is a screenshot of a back test. This happens to be Facebook. And I want to point out a couple things. First of all, this trade is included in that previous snapshot of the risk graph. So on day -1, this trade was down 32%. That negative number is included in that P&L chart. But this trader didn't need to hold this trade all the way till front expiration day. This is one of those trades that had a huge profit very early on. And this is a phenomenon. This is colored yellow because this is when the press release came out, announcing when their earnings date was going to be. And had the trader taken a chance on the estimated date, and it is a chance, there is risk involved in trading estimated dates. Because if we get the date wrong, your trade will turn into a loser right away. But if we get the date right, you can take a trade that was kind of just staggering along with a -6% P&L, and then the earnings release, press release comes out, announces that we got the date right in our estimate, and bam, 6% loser turns into a 65% winner. Now, if price is behaving nicely in between the temp holes, here's the temp holes, 110 and 124. Price is at 118 at this point. I probably would have held the trade. See if I could get that 65% to even increase. Because as long as price is behaving, what I teach people in the workshop is as long as price is behaving, hang on, be patient. Let the Greeks do their job. They're working for you silently in the background. But as price approaches the tent pole, 124, that's where the max profit is. Now, if price could just stay at 124 from here all the way to front expiration day, wouldn't that be lovely? This 86% profit would probably turn into 200%. I've seen higher numbers than that. But price doesn't always behave, and it looks like Facebook is pretty bullish in this scenario. It's just slightly through our upper tent pole. We have to make a decision on this day, a management decision. Am I going to hold this trade and hope that price doesn't keep climbing? Because if price keeps climbing, I teach you about delta inversion in the workshop, how if price keeps climbing and goes through the tent pole, that's that steep slope to losing money beyond the tent poles. So I teach you that you have to make a decision every day when managing these trades. You got to decide. You got 3 things that you can conclude. I can close this trade today and walk away with my 86% profit, or I can make an adjustment to protect myself against possible downside risk of price continuing to move up, up, and up, which is exactly what it did in this case. You went with 126, 128, 129, 132. Okay. So you got to decide, am I going to hold the trade? If so, am I going to adjust it, or am I just going to cross my fingers? Or am I going to close the trade? Those are the only three things you can do when you got a trade on. You can hold it, close it, or adjust it. This is the brilliant time to take your profit and run. That 35% on negative one day, that negative 35% is built into this statistic. Here's the breakdown of that chart. 1,609 trades. 502 of them losers. 502 losing trades. That is on 0 day, by the way. This is on 0 day. Not if you would have traded all 1,609 of these, you would not, just like that Facebook trade. Would you be in this trade on that Facebook trade on 0 day? Heck no, I would be walking away with my 86% profit. Right? When price hit the 10 pole. But if you would have held all 1,609 trades if you were a fool and let that 86% disappear, you would have been at, what was it, negative 7% on 0 day, negative 35% on negative 1 day. Okay? But if you held all 1,609 trades, no management, you didn't pay attention to Marko during the workshop at all, you didn't manage your trades, you didn't manage your risk, you would have had 502 losers. Well, that's the good news, is you would have had 1,107 winners, and the winners averaged 69%, and the losers only averaged 31%. So it's a pretty good statistics there. I'm liking it. There are some gamma risks involved in holding the trade into that final week. I'll teach you about the gamma risk in the workshop, and that's why we actively manage these trades and make decisions every day. It's a very cool trade in that you don't have to babysit it every day, all day, day in and day out. You check the trade, once a day, see how it's doing. Twice a day if you have time. If everything looks good, check it again tomorrow. If it's starting to approach one of the 10 poles, looks like it might need an adjustment, you need to pay a little closer attention. Very easy trade to manage, though, and to monitor. I shouldn't say to manage. Management takes skill and effort and experience. So that's what the workshop is for, is to teach you about management techniques. So there's going to be another free webinar next week, a week from today, called Back Office Tools. Just not enough time today. We're already starting to run out of time here. The Back Office Tools is going to provide traders a more in-depth look at the double eagle process, everything that we do in the background, that our research team does, that our employees do here at OptionSlam, that I do in the background to stay organized and focused in the strategy. We need to stay focused and organized in order to keep that revolving door going, that revolving door of putting a trade on this week and closing a trade out this week that we put on several weeks ago, and putting on another trade next week, and being ready, prepared, and knowing what's coming up next week. I already know what trades I'm going to be putting on next week. I already know what trades I'm going to be looking at putting on 2 weeks from now, because we have tools that we provide to our traders. All the people in the workshop get access to our management statistics tool, and it's live, updated almost daily, usually almost every day, especially during busy season. It's updated regularly, sometimes multiple times a day. Anyway, we're gonna show you. I'm going to show you next week, a week from today. Here, I can post that in the chat room. Let me do that rather than having to write that down. Let me post that in the chat room. Okay, Well, this is the registration link. So the workshop, I forgot to mention, is $10.85. That's the cost of the workshop. It's a 5-week course. We'll discuss this in a minute. Let me get this copied and pasted into the chat. Okay. If you don't get it, it's easy. This one is optionslam.com//training course. That's the link. That's the URL to get to this sign up page. So let's talk about it. I won't read the 7 reasons. We've got other things to get into. You get the, I'll tell you, I'll show you, and I'll go back to PowerPoint and I'll show you everything you get in the workshop. The workshop starts Saturday, April 13th, okay? That's April 13th, Saturday. It's a 3-hour class, okay? It's pretty intense. It's a solid 3 hours where I teach all about the double eagle, trade initiation, a whole bunch of stuff. I'll show you everything. I've got a slide in the PowerPoint to talk about that. And then we go again after that first Saturday, immediately the Monday during trading hours, we have another session where we actually trade together. We design a trade, we initiate a trade. I teach about how to get filled on these trades, different ways to get filled, how to design the trade properly, choose the correct strikes, timing of when to enter the trade, et cetera, et cetera. And every Monday, 4 Mondays in a row, we're going to have sessions. Now, these are scheduled to be 2 hours long. I don't remember ever getting one completed in 2 hours. They all go 3 hours. They all go 3 hours, but they're scheduled for 2. If you can't stay for the entire event, or you can't even attend the event, they are all recorded. They're all recorded, and they are made available to you. Download to your hard drive for your permanent record. Many, many, many traders have told me that they listen and review the recordings over and over and over again because they pick up something new this time that they missed last time. I've got many traders who have taken the workshop many, many times. And by the way, if you've taken the workshop before, you'll be getting an opportunity to get in. Once you've taken the workshop, you don't pay the full price anymore. You get a 73% discount, okay? And you get a full quarter of management statistics tool included with the workshop, even at the discounted 73% off price. If you've taken the workshop before, don't worry. I will be sending you a link to get in at the discounted price, okay? It'll probably be next week. I'll send you a link to get in at the discounted price. If you have not taken the workshop before, I'm only taking 30 new people. And believe me, this has sold out every time that we've put it on. This time we can only take 30 new people, and it's going to be first come, first serve. So I would suggest you don't hesitate if you're interested in learning how to trade the double eagle and have access to all of the tools that we provide with the workshop experience. Next week, Back Office Tools is going to show you give you some insight into everything we do here in the background to take all of the hard organizational work, back testing work, statistics developing, database management, all of that work we're taking out of the picture for you. All you have to do is have access to the management statistics tool. You'll have all of our statistics, you'll have our data, and all you have to do is trade the strategy. We have taken all the hard work out of this for you. These are the tools that we use in the background that I'm going to show you next week, okay? Anyone who's interested in seeing the background tools, I'm going to show you a little bit about our master database, P&L summary reports, which I don't think I have time to show you that today. That's why I'm doing a separate webinar. We've got, these are tools these are not provided. These are not provided as part of the workshop. These are things that we use. I'm going to show you on the next slide, I believe, everything that is included in the workshop. liquidity rating. This is a tool that is under development that we hope to make available to our traders someday. We have that tool, and this is a very powerful tool that we use every day that actually goes towards producing the management statistics tool. And we have another new, really exciting tool, the IV Build Forecaster, that is also in development, that we also hope to make available to our Double Eagle traders someday. But these two things, TradeBuddy and IV Build Forecaster, they are under development. They are not available for distribution. They're not included in the workshop. We hope to be able to provide them to you at some point in the future once we get through the beta testing and development stages. Very powerful tools, both of them. The above tools are either under development or proprietary and not available for distribution. Tools that are included in the Double Eagle workshop. The trade tree for entry decision. This is the trade tree for entry decision is a kind of a flow chart type of a document that helps guide you in how to decide which trades to enter, which trades to pass on, how to enter the trade. It's just a great document that guides you and follows our trading plan. Flowchart for management decisions is also included to help guide you of when to make an adjustment and what adjustments to consider. Those kinds of things, management decisions. Strike selector is just a little Excel calculator that helps you choose the correct strikes so that you don't make a fat finger mistake. Trade tracker is a Excel sheet that allows you to input all your double eagle trades, and it keeps track of for you all of the statistics of your trades, as well as profit and loss performance. I don't have time to show all this stuff to you today. Certainly, we're already an hour into it. Adjustment matrix. This is a tool that expands on the management decisions tool and shows you all the different ideas that you can employ in adjusting a trade. If you got a trade that's getting in trouble because it's gone through one of your temp poles, how to handle that. Bunch of different ideas on how to do that. Personalized support. Email me, call me. Private GoToWebinar sessions as needed. Whoop, I didn't mean to do that. Personalized support, that's basically me. You got me backing you up. And I got traders who still come to me that took the workshop years ago. Say, hey, Marko, I got kind of a tough situation here. Could you help me analyze it and go through it? Most traders have been around that long, though, don't need me anymore. They got enough experience under their belt. But there are a couple, and I don't mind. I'm here to support you. I want this is such a powerful strategy. I've had so many traders tell me, I never made money trading options. I've been doing it for years until I found the Double Eagle. Now I make money. The workshop also includes 1 full quarter of access to the management statistics PDF, which is, in my opinion, critical to have the information to stay focused and organized on the strategy. It's a bunch of testimonies. I've got 100 of them, if not more. I'm not going to read them all to you now. You can pick up the recording of this webinar today and read them in your own time. The Double Eagle pre-earnings release discipline. This is a little bit more about what's included in the workshop. General concepts, including definition, mechanics, and construction of calendar spreads. Understanding how the Greeks apply. We get into that, not real deep, but extensively enough so that you have a good understanding of how the Greeks are working for you and how some of them can actually work against you. Double Eagle setup parameters and guidelines. Lay it out for you exactly how to set up the trade, how to choose which strikes, how to choose which expiration cycles, when to initiate the trade, when to close the trade, choosing the best stocks, proper strike selection, choosing the proper expiration cycles, managing and adjusting, profit targets and stop loss considerations, historical examples of the trade in action, future examples of trade ideas for specific stocks coming up soon. This is all happening in the 5-week workshop. What can go wrong and how to avoid it. Really important. What can go wrong and how to avoid it. Trade variations. You can't avoid everything. I had one today, was nicely profitable. I took half of my contracts off yesterday because the stock was at the tent pole. It was at the call side tent pole. It's Delta Airlines, by the way. What did Delta do? They pre-announced that they're going to have good earnings. Boy, was I glad I took half my profit off the table yesterday, because the rest of the trade, the other half of the contracts, went back to break even because the implied volatilities got sucked out of my longs. The stock went through the rest of the way through the tent pole and went up $3, I think. Above, I think I was at the 42 strike, and now the stock's at 45. By the way, that's a very low price stock. Most of our stocks are $80 and above. We do have some that are under 80, but we prefer those higher price stocks. These trades can cost anywhere from $50 to get into up to 1,000 or more for one contract. Depends on the stock. Okay. I really highly recommend that you have a trading account that has at least $5,000. Can you do the trade? Yeah, I have some people, I have some younger, newer traders who are trading the trade with accounts as low as $1,000. However, they can't enter the best trades. They can only enter those really low debit trades. Okay, so $5,000 is okay. That should be a minimum, I would say, of your trade account to trade this to get started. Of course, $50,000 is much better. $150,000 better yet, et cetera, et cetera. Okay. Specific tips and tricks on getting the trade filled, entry and exit decisions, Q&A, and more. The workshop schedule, Saturday, April 13th, and then every Monday, the 15th. What would that be? The 22nd, the 29th, and then May something, right? 3-hour class Saturday, Monday. First thing we're going to do, design and initiate our first trades. We're going to trade together. We're going to put some trades on together, place the orders, get tricks on getting filled. Some of the stocks that we trade are not hugely liquid, so we have to sometimes employ some getting filled tricks. So we'll learn about those kinds of things in the first Monday. Second Monday is mainly going to be, well, first we're going to manage the trades that we put on the previous week. If there's any adjustments, great. We are going to be studying how to adjust our trades in the second Monday. When to adjust, how to adjust, and sometimes when to not adjust. Sometimes to not adjust is a strategy that makes sense too. The third Monday, manage trades and initiate new. Every week we do that. Manage trades and initiate new. Every day of the year I look to doing that. But together in this workshop, we're going to do it together on Mondays. And we're going to talk about trade variations. We're going to talk about triple calendars, campaign calendars, unbalanced calendars, other variations, double eagle variations, monthlies instead of weeklies, 2 weeks of separation, 3 weeks of separation trades, selling the shorts a week earlier than the recommended short because of concern about estimated date, or selling or buying the longs further out in time than the recommended normal conventional long expiration cycle. These are all variations of the trade that we'll cover in the Monday 3, what I call Monday 3 session. And then really fun stuff, in my opinion. And my son has just learned about this. He's one of those guys that does have a very small account, and he's just learning the strategy. Morphing the trade into earnings release week. Fronts expire worthless on front expiration day. You still own the longs, and next week is the earnings release. What can you do to parlay your investment, to expand and extend your profits? You don't have to close your longs on front expiration day. You can morph them into a vertical spread, a credit spread, iron condor, a butterfly, a back ratio spread, all of these ideas and more. I will be teaching how to morph your trade to extend and the profits beyond front expiration day. All right, so let's see. I think that's about it. I think this is the last. Yep, this is the last slide. Double Eagle, pre-earnings discipline. Okay, excellent question, Richard. Yes, the management statistics tool is available. It's included with the workshop for through June 30th. Okay, let me put that screen back up. Does it say on here? It should say on here through June 30th. Management statistics tool, good through June 30th. Richard wants to know how much does it cost after that. Well, there is a cost for it. It's $85 per quarter. We just lowered the price of the management statistics tool here a few months ago. We've got enough subscribers now to the management statistics tool that we're not trying to make money on that. We're only trying to cover our costs on that. So we just lowered the price to $85 per quarter. That's 3 months of management statistics tool. And what it is, it's a tool that it's a link, you favorite it, it's a web page, it comes up in your browser, one click. And it populates in your web browser on your screen. I suggest to people to hit the refresh button. Hit the refresh button every time you look at it during the day, just to make sure that you're getting the most recent update of it, because we may have made a change to it. We may have confirmed a date for an earnings, or we may have added a comment. Here, I'm going to show you. Let me show you. Yeah, here. This is one of the tools that we have in the background. This is basically, now I've got the symbols are not showing here. The symbols are not showing. I don't want to give away. We got a research team here that's been working very hard for years, developing, helping us to develop our master database, and all of these statistics come from our master database. Okay. So this is essentially what you get in the management statistics tool, but it's updated, constantly being updated, right? And you get all these statistics. You get the timing of when the suggested trade date is going to be. You get what was the average price of the stock. In all of our back testing data. This number over here, you see where my cursor is over here. It's let's see if I highlight that. See, this stock is new to our list, and it only has 4 back tests. Okay, only 4 back tests, because this stock not only new to our list, but it's fairly new on the market as well. And it hasn't had options that long, so we've only got 1 year's worth of earnings data. The next one you see has 17 back tests, and then we have the average profit, the median profit, the average strike spread. You know, how much distance between the call and the put, how much, and so that you can compare what was the historical statistics of this stock in our database, and compare that to, you just modeled up a trade and you say, okay, looks like the average debit was $53 in these 17 back tests. But I'm modeling this trade up, and it's $75 today to put this trade on. So I got to figure out, why is it more expensive today than it was on average over those other 17? Can I justify entering at $75 or not? So we teach you all about how to make those trading decisions, again, in the workshop. One of the reasons why it might be $75, because the average price of the stock was $99. But now the current price of the stock is $105. So the stock is higher priced. The higher priced stock is going to demand a higher debit for double eagle entry. So we have, this is basically what the management statistics tool looks like, and this is how it keeps you organized over. And this is as you see, you see we're going to have some slow times coming up, and I purposely do this workshop at a time when we're going to have some slower weeks, when there's not a lot of stocks to trade. I specifically designed this workshop to be done in a slow season. Right at the end of our busy season starts a slow season. And I do that on purpose because one time I did it in busy season, and I had several traders got all excited, and they started entering all these kinds of trades, and they got themselves in trouble, and they were way over their heads. They had 25 double eagle trades on, and they didn't even know how to manage them yet. So ever since that happened to me once several years ago, I learned that no, now we do the workshop when things are slow. I work with you for 5 weeks. And then right before busy season starts, we get together again. I usually don't tell people that ahead of time. I just do it. But right before busy season starts, we get together again, and it's a free webinar. And this is the first time I've ever told anybody about the free bonus session. I always do them after each workshop. We trade together for 4 or 5 weeks. Then you're on your own for 4 or 5 weeks. And then right before the next busy season starts, we have a free bonus session where we all get together again, and we talk about the trades we've been in. We manage any trades. I help traders get through and design adjustment ideas for trades that they might have currently. And and answer any questions that may have come up, okay, right before the next busy season begins, which will be, let's see, next busy season will be basically next busy season. You see how busy it gets here? So about beginning of June, middle of June. Middle of June is about when the next busy season gets here, okay? So anyway, that's a peek. We'll get more into that in the webinar next week, okay? The back office tools, because that sheet that I just showed you is one of our back office tools. That is one of our back office tools. $85 to answer your question per quarter. That's less than $1 a day. Clement wants to take the workshop again. We already have a couple people signed up, Clement, that have already taken the workshop. I can provide that link. Money management, a little bit. Neil asked about how much to allocate in trades. Yes, we do discuss money management, but not to a great extent. I do make recommendations as to how much money to allocate towards each trade, towards each stock. I do make recommendations as to how much money not to exceed. We do talk about it, absolutely, Neil, but restricted to the strategy that we're talking about. Lewis Austin. Lewis is already subscribed. That's great, Lewis. You're gonna love it. I've got nothing but positive comments for years and years. So looking forward to working with you, Lewis, and I'm here for you. All right. Well, that's all the questions I got. So I guess I'll let you guys go. Hopefully, some of you will be taking the workshop with us. Again, like I said, I have to, because I support all the traders personally via email and other forms of communication. I cannot take on more than 30 new traders. Okay. I can take on, all the people who want to retake the class. They don't need a lot of hand holding, right? So I'm not worried about resubscribers. But new people, I would suggest you don't drag your feet too long. Looking forward to working with you. Goodbye for now, and good trading.